middays from the Element Wealth Studio. We're pleased to welcome now Jeremy Nelson, partner at Element Wealth. All right, Jeremy, I'll tell you this, that right now I'm liking what I'm seeing in the markets. I'm kind of pleasantly surprised. We had a negative day on Monday, and that's because it just seems like we're dang hyper-focused on every word Jerome Powell states, and then any sort of indication of where the Fed may stand with respect to the future of the benchmark interest rate just seems to be driving investor sentiment more than just fundamentals and technicals of just good old-fashioned making a profit.
It absolutely is, right? And we've seen this, look, over the decades, the Fed matters and everyone pays attention to what the Fed has to say and what they do. But post-financial crisis, Adam Parker, who was the former chief strategist at Morgan Stanley, I remember in about 2011 or so, he kind of coined the phrase "bad news is good news" because it meant that you were going to get more accommodation from the Fed, right?
That's right.
And ever since the financial crisis, we really have been driven by monetary policy, bailing out bad fiscal policy, but ultimately, right, what matters, where the rubber meets the road, is companies making money.
Sure.
But the market does trade in the short term on sentiment. And what we're seeing is, I think that the Fed is concerned that things are getting overheated, right? Because you've got a stock market that's expensive. I'm not going to say it's not a bubble or anything like that, but it's not cheap, right? And they're concerned that if they start, backing off rates too quickly, that things are just going to explode up, and then ultimately, boom, you do hit a bubble. So it seems like, they're trying to get in front of the market a little bit, say, whoa, slow down. Yeah, we're not quite ready for March, and now everyone's kicking it out. Okay, well, it'll be May when they start cutting. But at our economic forecast events, we showed here's what the market expects out of Fed funds for the year, and it was forecasting about 6 rate cuts, and we just said, there's no way they're cutting 6 times, not with the strength that we're seeing in the economy right now.
Right. Yeah. And that seems to be somewhat prescient because now we know that a March cut's off the table, and the indication we got Monday is that May's probably off the table. And so the market's just said, sell off.
Look, I mean, how do you go in and cut rates when you're still not to the level you need to be at, right?
From an inflation
perspective. Yeah. Mm-hmm. And you're still at full employment. I mean, sure, we're starting to see, a few more cuts kind of in the tech sector largely, right? We saw like Snapchat come out and they're going to lay off some of their employees and a few other companies. But, overall employment is strong. I mean, all this infrastructure money is still flowing through the system, and that's creating a base of economic support. Plus, you got a $2 trillion deficit going into the economy right now, right, helping things out. So very, very tough for the Fed to say we're going to cut right now.
Yeah. Well, and they still seem bent on achieving the 2% target. And I think it's fair to say getting from 9 back at the peak in 2022 down to the present level of 3.2, that was perhaps an easier task than getting from 3.2 to 2.
That's it. It's finishing the job is the challenge, right?
Yeah.
I mean, we all knew that some of this inflation was going to take care of itself because a lot of it had to do with the supply chain issues during COVID, right? And we knew that those were going to ease and get better and that inflation was going to come down. But really finishing the job and getting down to that 2% is where the challenge is. And I don't think that they're overly restrictive right now. I mean, we've seen their holding rates here. They haven't continued to increase in, 6+ months now, right? It's been a good while that they haven't raised rates. They're continuing to work the balance sheet down. That's what nobody talks about. But, they've brought the balance sheet down about $1.3 trillion, so they're letting assets roll off. I think they just need to hold course right now.
Yeah, of course. At the same time, of course, that they're shrinking their balance sheet, the Fed at least, we got on the fiscal side, we got the Treasury spending like crazy, and they're having to sell more bonds and raise money to cover our spending.
And ultimately, this is the long-term issue, right? I mean, because when you start looking at the interest on the debt and where that is going. Now, look, people have to understand, we're still nowhere near as a percentage of GDP what we were in the 80s. But you got to remember where interest rates were in the 80s as well. But at the same time, in the 80s, you didn't have the same level of spending on entitlement programs. There was more room in the budget to figure things out.
Yeah.
I mean, we're on a track where we could easily, if we continue on this path, get to where interest costs are the same as the military.
Well, I think we're pretty close to that right now, honestly. And it wouldn't shock me if that doesn't happen in fiscal year 25, 26. It'll be neck and neck.
It's getting up there. So that's where you start running into, the big issues, because you were just talking about it on the segment before I was listening. And look, there's no way that you can address this issue without addressing spending in some shape, form, or fashion, right? I mean, ultimately, there's going to have to be some compromise on both sides to address this issue so that it doesn't manifest into something much bigger. Yeah,
and to your point, and we just wanted to also clarify that sometimes folks get a little upset about use of the word entitlements, and that is what Social Security and Medicare are referred to, and that really just means you paid into it, thus you're entitled to it.
Yeah.
So I just want to share the context there.
Exactly. And I've always been one. I don't like the fact that we call it an entitlement program because it feels like it's free. Yeah. But I mean, hey, we're putting our money in out of this, and we expect to get out of it.
Exactly. Yeah. So when someone refers to just pure redistribution welfare as an entitlement, even though you've really not paid anything to earn that entitlement, that's a different story.
Yeah. Very,
so I just wanted to make that distinction. But to your point, so we could get busy, and this is what I was trying to convey in that segment that you probably heard, is that I'm all for eliminating all the frivolous, unnecessary, duplicative, and just crazy spending and all the waste, fraud, and abuse that occurs, honestly, throughout the spectrum of government. I'm all for that. But at the same time, you're kind of nipping at the heels there and trimming around the edges. Interest costs keep going up to offset that, and spending on entitlements, which is on autopilot, which is statutory, it keeps going up. So you're not really making any progress. It doesn't mean don't do it. It just means that you got to be bold and do more if you really want to do something meaningful.
Ultimately, there's going to have to be a big plan. Now, look, this is an election year. Nothing is going to happen.
Zero.
Right? We did our forecast event in Mobile. We were actually interrupted by the congressman from Mobile. He came into our event.
Oh, okay.
And it was kind of funny because it was right at the point in time when we were talking about the debt and deficits, and he said, sorry to interrupt. I said, actually, Congressman, perfect time. We just finished this section. What are you going to do about it? And his response was, well, we can't even get our own party in line right now.
I totally agree. And so you can scream and cry blood and dance and do everything else you want, but you got to go bold. And by the time you even get to a point where you do something sort of minor, and unfortunately $100 billion these days is minor in a $6.3 trillion budget with a $2 trillion deficit.
Yeah.
And as far as the eye can see, we're set for $2 trillion deficits.
Absolutely. I mean, I don't see where they're going to be able to cut anything that dramatic and that significant that's going to shore up that deficit right now. And ultimately, I mean, what you're doing when you're spending in deficit levels like this is you're pulling from the future.
Yeah.
Right. And so it's just like us, right? If we spend more money than we make, eventually we got to pay it back, right? And so that's why I do think, though, that pro-growth policy is very important, because you got to be able to grow your way through this. But you really have to cap spending, cut back, right? This isn't something that's going to be addressed overnight. You can't address $2 trillion in 1 year, right? But it's something that has to be a major focus, and you're ultimately going to have both parties on the deal.
And there's no consensus there, because one party may have an appetite to truly rein in spending. The other party believes that the way to address the deficit is to raise taxes.
Yeah, and that's, some level of figuring out how to raise revenue is going to be important. Now, growth can handle some of that, right?
Yeah.
But you're not going to be able to really go in and come up with a plan where you're going to cut taxes.
But raising taxes is not necessarily pro-growth.
Exactly. So it's a catch-22.
Yeah, exactly. We got Jeremy Nelson. He's a partner at Element Wealth. We're coming right back in the Element Wealth studio. Stay with Element Wealth studio. We're visiting with Jeremy Nelson, partner at Element Wealth. So, bright spot the last couple of weeks, earnings reports coming down from the big technology names, the mega caps. Unbelievable. I mean, they blew it out. Microsoft, Amazon. The one that shocked, of course, Meta. Mm-hmm. Unbelievable up 20% Friday, 82, 81 bucks a share or so. And there's some analysts that are putting it's what, 400 or so, I think, right now, and they're putting
468, yeah.
Okay, they're putting a north of $600 price target on it, and it shocked everybody. Beat top and bottom, $14 billion, biggest quarter of net income, net operating income, biggest quarter in their history. Does it seem like you think Zuckerberg has kind of gotten back to focusing on their core business? And also stripping some frivolous expenses out of their model, and that contributed to this record quarter.
We're seeing this across the tech sector right now where, it wasn't about making money in years past, right? And so we always knew that these companies had tremendous free cash flow and they could make investments in growth, but they overhired, right? And so we saw, in 2022 and then in 2023, that the market kind of said, no, look, we want to see that you can make money. And so they started cutting headcounts. When's the last time that you heard about Facebook or Meta and the metaverse? Nobody's even talking about that anymore, right? But in 2021, it was all metaverse. And now it's like, no, we're making money, right?
Advertising.
We're past that. Now, we did see Google, right? Google missed on advertising revenue, so maybe Facebook or Meta picked up on some of that. But overall, what you're seeing is a focus on profitability, a cut in headcount and spending. So they're being much more fiscally disciplined, which long-term is a good thing.
Yeah. Well, and then, of course, Apple, world's most valuable company, on any given day, somewhere vacillates between them and Microsoft, and Amazon's now on their heels. But my gosh, even though their guidance was a little negative and they took a little hit, they made $34 billion in the quarter. $34 billion.
They're making it. The challenge there is that the revenue growth is stalled.
Yeah, right. and largely due to concerns about future sales of iPhones, which still comprise a big part of their revenue mix. And then the challenges they're having in a giant market for them, which is China. Mm-hmm. But here's what I think is going to happen. I think they're working on some sort of AI functionality that's going to be embedded in the device or the operating system itself. And I think we'll see that in the next couple of years. And when we do, there's about 2 billion cell phones, Apple iPhones, that are going to upgrade. There'll be something compelling them because it's going to be embedded in almost all the apps on the platform.
The question mark is going to be the price point that consumers are willing to pay.
Agree.
Right. I mean, because you think about it. I mean, your phone is more expensive than buying a computer now.
Yeah. Well, Rhino's pointed out the Vision Pro, which is, $3,600 or something? I mean, it's got a very high price point, and I agree. But still, though, that sort of refresh cycle could generate a bunch of revenue and a bunch of profit. And, their margins on iPhones are quite high. Well,
I mean, if you think about it, I mean, if your iPhone over the last, 5-6 years, what's the only thing they ever change is the camera, right?
Camera's been upgraded.
Better camera.
Well, a little better battery life, maybe.
I don't care about my camera.
But AI functionality,
that would be big.
That'd be pivotal.
Things that will improve productivity. And I've been a big advocate of AI and explaining to people it's not bad. It's not necessarily going to take over the world. It's not the robot uprising.
Yeah.
But if you take the approach or view that labor productivity, right, our ability to do more in an hour is the backbone of economic growth,
right.
And AI is that new thing. It's like the computer, back in the 80s and 90s, right? Once we got to that mass adoption, we became much more productive. So AI is definitely something in the future that we are going to benefit from economically. We're not there yet right now. I talked to people that work at Google and other companies that are friends of mine, and it's not there today, but it's getting there.
It's coming. I mean, you're going to have to start showing some sort of returns on these massive investments. And as you well know, I know you track all these companies, there's not a company in this country that doesn't have a major AI investment and has commissioned some sort of effort. Regardless of industry, doesn't matter. It's absolutely transcending every industry. And there are a lot of companies that have benefited from that. Accenture. I just read a report this morning. McDonald's has got a huge AI effort underway. And you think, what do they need that for, selling hamburgers? They're talking about some sort of AI technology. They didn't really get into details, didn't provide any color, out in the restaurants.
Yep.
I mean, for the servers.
It's fundamentally going to alter the labor market, especially on the lower end of the labor market from a wage perspective, and it's going to take massive capital investment, and there's going to be some trial and error with these things. But ultimately, I think that it's good for productivity and profitability in the future.
And I only brought this up because it's a bright spot, and I think largely that's dragging the entire market. These stellar earnings reports we got from these big mega cap technology companies, which is typically considered to be where all the growth is.
Yeah, the challenge is to if you make the mistake of extrapolating the current growth rates into the future and you assume that it's going to continue at that rate, you're probably wrong, right? And so the challenge is how much do you pay for those future earnings and valuations and things like that.
Yeah,
I use the example of Microsoft. If you go back and look at Microsoft, in 2000 peaked, and then it took 15 years for the stock to get back to where it was, despite the fact that they'd basically doubled or tripled their earnings over that 15-year period of time. So investors just have to be very careful about what they're paying for these companies. And now look, if they continue to grow at the rates that they're growing, sure, but the law of large numbers does start to catch up at a certain point in time.
And it's cyclical. Yeah. I mean, because my experience just being in the technology business, just as soon as something kind of starts to level out, become mainstream, almost a commodity, boom, something else is invented. And those that are aware of that and can react and are agile and have management structures that can take advantage of whatever the next frontier is.
And the market will change its tune. I mean, if you think about Apple back in 2012, right? Apple traded well below the market multiple, right? So they were trading at a discount to what the S&P 500 did because it was viewed as a devices company.
Yeah.
And then all of a sudden they changed, the market changed its tune and started putting a tech valuation back on it. So investors just have to be really careful. It's important to be diversified. It's important to understand that there are other assets out there that are undervalued or reasonably valued. You want to make sure that you stay diversified because if you think that just like last year, 60% of the returns are going to come from 7 stocks for the long term, that's probably not going to happen.
Yeah, it's not sustainable long term. So let's talk about your services, and I'm happy to let the audience know I have before that I'm a satisfied client, and I guess I'd put myself in the cashed out retirement phase, if you will. But you have a lot of clients like that. You advise a lot of clients that reach that situation and have accumulated a bit of a nest egg, and they want to put that to work and protect it. Of course, they have to live off of it as well. So talk about your approach there.
Yeah, so what's really important for clients is that you go through a process, right? You inventory what you own, what's your future cash flows, because why do we save money for retirement? So that we can turn that into a paycheck and maintain our lifestyle. So it's very important to have a plan, right? And my belief is this: you got to create a framework that's unique for everyone of a balance of income growth and guarantees. Sometimes people get way too aggressive and they start chasing things, and then you can blow your retirement up by being too aggressive. Some people are too conservative and they forget, hey, I still need stocks and long-term growth assets in my plan in order to achieve the goals that I have. And think about inflation over time, right? So you need growth in your portfolio. It's just critically important that you're diversified, that you understand the risk that's in your portfolio, that you understand where your paychecks are going to come from. And now, I mean, especially with required minimum distributions, going out to age 75.
Talking about 401ks.
401ks, IRAs, things like that. You've got a gap where you can do things like Roth conversions. I did a calculation for someone yesterday. They're retiring with about $1.2 million. By the time that they're 100, now they'll probably live to 90, but this is factoring in the 10 years before their kids have to pull out the money. It was like $3 million in difference if we did some smart things with Roth conversions.
So you basically you convert, you pay tax now, and then in the future nothing's taxable. It's tax free.
And we just do it over a window of time. For them, it was going to be 11 years. Yeah.
Well, something else I point out, and we got to go here, but if you're thinking about doing this on your own, one thing that I'll point out, I've been in your office many times. You've got access, because of your line of work, to tools we just average people don't have access to. And I rely on you and the use of those tools to take care of my assets. I don't have the time, the knowledge, nor access to those tools. Yeah. I point that out. It's a critical distinction between the individual investor and an institutional investor.
That's why I don't do my own technology in my office,
there
right?
You go.
We got computer people for that.
Same deal. Appreciate you coming in, Jeremy.
Appreciate it. Thanks, Sean.
Man. Coming right back, folks. Half an hour left in the Element.